As to my selling, it had nothing to do with market timing. It had nothing to do with trading. It had to do with the fact that I thought that the junior mining shares had gone too far too fast. Specifically, I was able to sell 25% of my holdings in the sector. I'm going with my own money a couple places that are hated. The U.S. community banking market, not just my bank, Battle Bank, but the community banking market is priced at levels reminiscent of the late 70s or the Great Depression. The other thing I'm doing is oil and gas. Oil and gas is widely misunderstood and widely unloved. The perception in the world is that we're using less oil, which is not true. I believe as a 2-year investment, a 3-year investment, and particularly a 5-year investment, that oil stocks are today where the uranium stocks were some years ago and where the junior gold miners were in 2022, which is in other words, a different way of saying I'm buying hate.
You're watching CapitalCosm. My name is Danny. It is October 30th, 2025, and my guest today is the legendary Rick Rule himself. Rick, thank you so much for coming on, my friend.
Pleasure, Danny. It's been nice over these years to watch the growth of your channel and participate in my own small way in these discussions. So thank you for the opportunities.
Oh, I guarantee your contributions were not small, but thank you nonetheless, good sir. Let's go ahead and dive right into what's on everyone's mind is the gold and silver price. Let's go ahead and get your thoughts on that. I'm going to share the chart here with everyone here in a second, but I've got to give it credit to you, Rick. I mean, you've been on this channel, you've gone on other channels. I don't want to say you called the top, but you were pruning your portfolio, and you did seem to get out at a fairly good time, relatively speaking. So here's the gold price right now, currently trading at $4,005 spot price. Silver currently trading at $48.75 spot price. So go ahead, Rick.
Let's put it all in perspective, Danny. You and I probably started talking in 2022, 2023.
Mm-hmm.
So if you look at that period from then to now, did the gold price rise from 2,000 to 4,000? Or did it fall from 4,200 to 4,000? In other words, did we get a $2,000 price increase or a $200 price decrease? And I think that matters. I think in the next 10 years, that the nominal price of gold measured in US dollars increases substantially, perhaps threefold. What that means is that the blip that we've seen in the last 3 weeks is just that, a blip. And I think that you need to put that in context. I think this market has a long way to go, but that long way is going to be punctuated by blips like this and more severe often. And if your audience isn't financially and psychologically prepared for those blips, they're going to get shaken out for no reason whatsoever. I remember a blip called 1975, where the gold price declined by 50% over 9 months without derailing the gold bull market. So understand that this will not be stair steps to heaven. As to my selling, it had nothing to do with market timing. It had nothing to do with trading. It had to do with the fact that I thought that the junior mining shares had gone too far too fast. Specifically, I was able to sell 25% of my holdings in the sector and take out all of the money that I had invested in the sector since the year 2020. I was able, in arithmetic terms, to trade 25% of my upside in return for eliminating 100% of my at-risk downside. I was also able to shift the money, the proceeds, from a sector that I thought was in the near term fully valued into places that I thought were more attractive. In particular, half the proceeds from those sales went into physical gold itself, a lower risk way to play the same game, and into the shares of 3 senior companies, Wheaton Precious, Franco-Nevada, and Agnico Eagle. In other words, I maintained the beta part of the trade and I gave up part of the alpha. The rest of the proceeds, the other 50%, went in the oil and gas business, which I see as being as roundly hated now as the gold trade was in 2022. So, there's a couple important lessons there. The first is that gold and the gold stocks have a long way to go, but they're going to be volatile and they're going to be cyclical. The second is that my selling had a lot to do with individual portfolio management, more to do with that, frankly, than it had to do with my perceptions of the market. But the third part is, as an investor and a speculator, I chase hate, not love. And the gold market, particularly the junior gold market, isn't hated anymore.
Yeah, I'm pulling up an oil chart right here. Let me know if you can see it. But it is gone nowhere but down in the last several years. And when you look at, let's say, oil divided by gold, you can see the relative valuation between the two. And I believe we haven't seen anything at this level in quite some time. Let me pull it up. So if I look at this ratio from a long-term perspective, putting aside the big negative oil price of 2020, there really isn't any other time where it's really gone down to this level. This chart goes all the way back to the 1950s, let's say, and oil priced in gold is all the way down here at the present moment.
And Danny, I expect that chart to continue. Oil is US dollar terms, and I expect gold to do well relative to the US dollar. So I expect the gold oil ratio to probably continue to decline.
Well, this is the oil to gold ratio.
Yeah. Well, okay, the other way around.
Yeah.
Oil priced in gold, it wouldn't surprise me if oil priced in gold continued to decline. That doesn't matter much to the profit. Well, probably helps the profitability of oil companies, which is really what I'm interested in. The net present value of both. The chart that you showed is the chart of hate. That combined with the fact that burning oil generates carbon is responsible, I think, for the opportunity that's in front of us today. People are either bored of oil or afraid of oil, or they hate oil, all of which says there's more sellers than buyers. And bargain markets are a consequence of having more sellers than buyers.
Yeah, I mean, if you look at this chart historically, again, this is a very long-term chart. I'm going to look at it from a line perspective. So you can see we're well below if you were to draw an average line here, it'd be somewhere around, this 0.06, 0.05 level. We're currently at index at 0.02. So you'd need a 2 to 3x just to revert back to the mean, which would consist of either the oil price going up, the gold price going down, or some combination of the two.
And I don't suspect it reverts to mean. That doesn't do anything to harm my thesis at all.
I see.
I'm interested in absolute valuations rather than relative valuations to a different asset class. If, by contrast, you ran a chart of sustaining capital investments in the oil business relative to revenue in the oil business, what you would see is that sustaining capital relative to revenues is at a real low. And sustaining capital is the stuff of production maintenance or production decreases going forward. If you looked at another chart, which is free cash flow generated relative to historic norms, you would see that the industry is enjoying spectacular free cash flow. But rather than investing it traditionally, as the industry has done, in sustaining capital or new project investments, they are either in state-owned firms using it for politically expedient domestic spending programs, or in the private sector, particularly in Europe, returning it to shareholders by way of dividends or share buybacks. And this is really what my thesis is about. The International Energy Agency suggests that the oil industry globally, including state-owned firms, is underinvesting in sustaining capital to the tune of about $2 billion a day.
Wow.
That your investment translates into a difficulty maintaining production at today's levels 3 years out and 4 years out while demand continues to grow. That's the thesis. On top of that, of course, you have the fact that investors are either bored or afraid or feel hate towards the oil industry. The best, the easiest money to be made in speculation is buying hate and watching the sector go, perhaps not to loved, but merely to unhated.
Hmm.
That's what we did in uranium. That's what we did in the junior golds. And I'm getting set to do it again in oil and gas.
That's the easy money, right?
Yep, that is the easy money.
What about base metals? Lithium. I remember you mentioned lithium a while back. Do you see
I'm sitting
any
out of the
asymmetry?
lithium trade at present. I had expected lithium hatred to occur in 2026 or 2027. I don't believe that we ever had a shortage of elemental lithium. We had demand peaks from lithium ion batteries that overwhelmed our ability to convert that raw lithium into lithium chemicals. Those processing bottlenecks are largely eliminated, and hence the lithium prices collapsed. The lithium boom in exploration yielded a lot of potential new supply. I would suspect that we either discovered or rediscovered 150 deposits worldwide. There are probably only 10 of those that are economically viable in this pricing environment. That means that the shareholders of the other 140 have a lot more pain to come. What keeps me out of deploying to the 10 best projects, which is something I probably will do in 2026 or 2027, I say probably, is developments in direct lithium extraction. Technologies that may or may not work, but they're being pursued by little tiny companies like Berkshire Hathaway and Exxon
Hmm.
that would allow the recovery of lithium from saltwater brines, particularly those brines produced in conjunction with producing oil and gas. If direct lithium extraction works, which is to say that you can take a waste product called scale from the oil and gas industry and sell it as lithium, then it's going to be a very, very, very tough environment for the hard rock producers. And it's my waiting in particular for announcements from Exxon around production of direct lithium extraction experiments that are undergoing that's keeping me out of the lithium market present. I don't know if it's going to work. I don't know if it's not going to work, but I want to get some sense of whether it's going to work before I dip my toe in the space.
Does the same analysis also um, follow through with rare earths as well? So if I pull up a rare earth, this is the REMX ETF. That also
I
seems to be on the move up as well.
I'm not playing the whole game in rare earths because I don't believe that all rare earths deposits are created equally. And the ETF forces me to buy the good, the bad with the ugly.
Mm.
There are 3 or 4 rare earths deposits which I own, or I own, pardon me, the shares in the companies that own them. I'm looking for deposits that are potentially world class. I want 10 or 20 billion dollars worth of in situ recoverable reserves and resources at today's commodity prices. In other words, I want must own deposits. I want deposits that'll be in the lowest cost quartile worldwide and in the best quartile worldwide in terms of return on investment, but minimally 25%. What that means is that my field of choice is really, really, really constrained. I don't want to buy the sector so much as I want to buy the best undeveloped deposits in the world in the sector. I do believe that geopolitical tensions, not merely between China and the US, but between industrial supply chains, European, Japanese, Chinese, Americans, will mean that rare earths come to be viewed really truly as strategic materials. And as a consequence of that, that the current US and Chinese actions to subsidize this business by the state will yield lower costs of capital for the nascent producers. And I definitely want to play that game, but I don't want to play that game across the waterfront. I want to select the best of the best.
So just clarification regarding your selling of your junior gold mining stocks. Did you sell all of your gold mining stocks or just a
I,
selection of
I
them?
took my junior bucket and I define
Okay.
junior rather loosely. That includes some junior producers who I've owned. And I looked at the entire investment that I have in that sector going back to the year 2000, not my legacy positions, not the ones I
Mhm.
had tucked away in a safe deposit box, but my investments in the period 2020 to 2025. And I sold 25% of that bucket, not all my
Mhm.
gold stocks. And importantly, I redeployed half of the money from those sales back into lower risk gold investments.
I see.
In other words, with part of the proceeds, I bought physical gold. With some of the rest of the proceeds, I bought Franco, Wheaton, and Agnico Eagle. I decided deliberately to reduce my potential profitability in return for eliminating all of my risk.
Understood. Yeah, I'm looking at the GDXJ relative to the gold price, and the GDXJ doesn't go that far back. It goes back to 2010 or so. But
Yeah.
even regardless, this is on a log scale. If you look at it from a nominal scale, it even more exemplifies some of the asymmetry in
Yep.
the GDXJ. So, could you see yourself getting back into these higher risk gold plays sometime down the line as the gold bull market matures, or is this kind of a final goodbye for now, at least?
I'm going against the way I think the market as a whole will work, but I need to tell you that the GDXJ exposes me to some companies that I wouldn't buy under any circumstances.
Mm,
That's the nature of an ETF.
right.
They charge you very little to invest in a basket of companies, many of which you wouldn't otherwise invest in. I am not going to add to, I'm not going to add capital from other sources to my junior portfolio now.
Mhm.
I am going to redeploy the capital I have in the sector based on what I consider to be relative risk and relative reward calculations. To the extent that I buy a stock and learn I've made a mistake, which happens not infrequently, I won't wait to break even. I'll sell it and I'll redeploy that to other names in the sector. To the extent that I have in my portfolio a company, pardon me, that's misunderstood and hence I think undervalued relative to where it should be valued. If it comes to be fully understood and fully valued, and there is an opportunity to redeploy that capital in another name that I think has relative undervaluation, I will certainly redeploy within the sector. I am not going to add new capital to that sector. Please understand, though, Danny, by any conventional analysis, I'm way overweight gold and gold mining stocks. If a financial analyst were to look at my portfolio, he'd say, Rick, you're out of your mind to own any juniors, and you're out of your mind to own any gold. You're the largest shareholder of Sprott. Sprott is a brand name for money management and gold. If the gold price goes up, Sprott's going to do fine. You're stupid to own anything other than Sprott. Um, I'm overweight gold because I think gold will do well for 10 years and because I've spent 50 years learning how the gold market works. But I don't need to increase my allocation to the sector because my allocation's already huge.
Understood. Yeah, I mean, it's hard not to have an overweight portfolio given the recent rise. Not and by recent, I mean the last 2 to 3 year rise. But a lot of us here on the channel, we've been stacking gold for many years now, and so $4,000 gold is a far cry from where a lot of us started, and it's hard not to have an overweight portfolio as a result.
Agreed. What's amusing is that most of the noise about gold is still from within the gold community.
Hmm.
Uh, there is still a huge part of the population, the generalist investor, and I'm including institutional investors in this, who are underweight gold. So while you and I have an overweight portfolio that's become overweight organically, one of the things I like about gold is it's still a fairly lonely trade relative to all of the other available asset classes.
Gotcha. So I want to shift over to some macro news here, Rick. Yesterday on Wednesday, we got the announcement of another Fed rate cut. And today, a day later, I'm looking at the 10-year yield, and it's up about a percentage point. So I'm just going to take a look at the daily candlestick. And yeah, yesterday it shot all the way up at the news of a Fed rate cut, which is in a way counterintuitive. You would anticipate a comment, some sort of correlation with the Fed with the short end of the curve, but that's actually been a theme lately. Is that the longer end of the yield curve has not been responding in accordance to what the shorter end is doing. Now, this could be a buy the rumor, sell the news event. I want to get your thoughts on what you make initially out of the Fed's announcement for another round of rate cuts here. Hey guys, quick pause from the podcast, but this is something I feel is really important to let you in on. Back in 2020, before I even started this channel, I was looking for an edge, a way to find the big opportunities most investors never even hear about. That's when I found Capitalist Exploits Insider. From day one, it felt like I suddenly had my own team of world-class market pros working for me, digging up trades all over the world, doing the deep research, and handing me ideas that had massive asymmetric upside. Stuff that I would never even think about. Since then, my gains with them have blown past the S&P and the NASDAQ, and it's honestly the single best newsletter I've ever subscribed to. And that's not me blowing smoke. That's for real. I've interviewed their publisher, Chris McIntosh, more times than I can count. In fact, my latest conversation with him is linked in the description box down below if you want to check that out, as well as a pinned comment. And every time, I'm reminded why I've stayed a member for years. Right now, they're offering a special $1,000 discount on the Insider subscription, but it's only for CapitalCosm viewers, so you're only going to get it by clicking the link down below in the description box or the pinned comment. You're not going to find this anywhere else. Click the link, lock it in, and start getting the same game-changing research I've been using since 2020.
Well, I think that's the most important chart you show me today. That tells me that the market is beginning to reassert control over the long bond, not the Fed.
Mm-hmm.
You suggest decrease in the short rate would, in a normal market, lead to a decrease in the long rate. What you're seeing is the market saying that by agreeing to a rate cut in a fairly strong economy, that U.S. society has decided that they have no interest in defending the integrity of the U.S. dollar, and that the consequence of quantitative easing and this near-term rate cut is deteriorating market share of the U.S. dollar as a medium of exchange and a store of value, that it is inflationary, and that the market will need a higher yield on the 10-year in U.S. dollar terms in order to maintain that exposure. That's an extremely important chart.
Yeah. So we've
You
got
have
the
to go
10-year.
back to the first 2 years of the Clinton administration to see the Fed unable to control the long yield.
Yep. So I what I've done here is I've imposed the 10-year yield in yellow with the Fed funds rate in green, and you can see throughout history they pretty much track one another. But interestingly enough, fast forward to today, there was a bit of a disconnect given the last rate cut cycle, or I don't even want to call it a cycle, but last episode around this time last year too. You saw the Fed cut rates here in green, but
Yep.
the yellow line actually started going up.
Correct.
And what we're seeing today is this isn't discernible on this 1 month chart, but you can see the spike up here at the news given
Yep.
yesterday's announcement. So it seems like there is this growing detachment between the long end and the short end of the yield curve.
I see that as being really crucially important. The Fed and excess liquidity in the market drives the short rate. I own myself a lot of very short duration bonds because I feel that we're in a market where it is important for an investor to maintain liquidity. But I also understand that having that liquidity costs me real yield. If you are an investor who believes that the CPI is a relevant gauge in terms of understanding the real purchasing power of the US dollar, then you don't need to be concerned. I look at the CPI number, 2.9, as farcically understated. I believe that the deterioration of purchasing power of my US dollar savings is more like 8%. If you believe that the deterioration of the US dollar is at 8%, owning deposit products like the US 1 or 2 year Treasury getting paid 4% means that you're losing 4% a year compounded on your savings. I do that because I understand the need for liquidity in a period where I think it's not unlikely that we experience challenges. I have zero interest personally in owning any debt security with a duration longer than 3 years. To me, the arithmetic around the US 10 year, and that chart says I'm not alone, is that I get paid 4.5 in a currency where the purchasing power is deteriorating by 8, which means rather than making 4.5, I lose 3.5. Losing 3.5 a year every year for 10 years, which is to say 3.5% compounded, means I give the US government $100,000 and they give me back 60,000 in purchasing power. Not very attractive for me.
And so with the Fed, when they cut rates, what they're really trying to do is kind of juice up the economy, juice up lending, incentivize businesses to take loans, incentivize people to buy homes and things of this nature. But you look at things like the housing market, that doesn't look at the short end of the yield curve. Mortgage rates are based off of the longer side, the 15-year, the 30-year. And those are not responding to the rate, at least so far they aren't. But assuming that they don't respond and the Fed just cuts rates without all of the benefits that they initially hoped for to cut rates, what does that imply? What does that imply for the general economy? What are some of the downstream effects of that? If you just have lower short end rates, but all of the economic levers that were pulled to generate an outcome don't generate, what happens then?
The headline response is I don't know. What I do know is that in the circumstance that you talk about, if there's a liquidity crunch,
Mhm.
if there's a 2008, the Fed's ability to stick handle it is dramatically reduced. If you've already used up all of your gasoline, before the event takes place, you have much less gas to use. That would be my fear from their perspective. If there's enough confidence left in the economy, and they drive the short rate down long enough, that group of people who I call the yield whores will likely pull down the long rates. In the mortgage market, as an example, conforming loans, uh, FHA, that kind of thing, Fannie Mae will continue to catch a bid as long as they're perceived to be relatively riskless assets. Um, I myself don't consider them to be relatively riskless assets because I have a memory that stretches back to 2008. But if the government is able to restrain concern around credit quality, and if they drive the near term rate low enough, the long term rate probably begins to follow as the yield curve steepens. For those investors who are unconcerned about credit contagion or unconcerned about the deteriorating purchasing power of their principal, likely will be forced into the longer end of the curve. That's not a game I'm personally willing to play. I don't have any interest in the long end of the curve. I'm not one who's going to say that confidence vanishes overnight, and the consequence of that is that they have a catastrophe. I don't know. I'm just not interested personally, Danny, in finding out.
Yeah, fair
We'll
enough.
find out with somebody else's money, not Rick's.
Hmm. No, it makes perfect sense. Well, I mean, this is pretty much all I had in store for us today here, Rick. Anything else that's pertinent on your mind, on your radar screen that you want to talk about before we close things up here?
Well, I think one thing you and I have done a fairly good job over time about talking about moving money into sectors that
Hmm.
are hated. And I'm going with my own money a couple places that are hated. Uh, the U.S. community banking market, not just my bank, Battle Bank, but the community banking market is priced at levels reminiscent of the late 70s or the Great Depression. Uh, Banks come in all types. In movie parlance, the good, the bad, and the ugly. And investors who don't understand the banking business are looking at banking macro and looking at the risks of banking, and they're throwing out the babies with the bathwater, which is great. I mean, there's some spectacular community banks selling at discounts to book that are generating 15% after tax returns on capital employed and are able to redeploy that capital at the same high rates of return. That's stupidly cheap. So I'm doing that. Am I going to get love out of the market? I don't care. If I can buy a business below book that's earning 15% after tax on book and redeploying that 15% at the high rate of return, I've got an earnings machine. I've got a true wealth machine. So I'm doing that. The other thing I'm doing is oil and gas. Oil and gas is widely misunderstood and widely unloved. The perception in the world is that we're using less oil, which is not true. Uh, because the market perceives we're using less oil, the big thinkers of the world are suggesting that peak oil demand occurs in 2030 or 2032. I don't think peak oil demand occurs in my lifetime, and I'm a very healthy 72-year-old. I don't even think it occurs in your lifetime, Danny.
Mm.
Uh, what that means is that when people are doing net present value calculations, they're forgetting most of the backside of the value curve. And I think that they're undervaluing the public oil and gas sector by as much as half. I also think that with deferred sustaining capital investments of over $2 billion a day, that we will face globally production shortages as soon as 2028, meaning that today's oil prices, I think, will rise substantially, at least in nominal terms. So you're buying an industry today at a 50% discount, where the net asset values that you discount from today are twice as high 3 years from now. Uh, and in addition to all that, the market is hated, truly hated. A lot of my life as a speculator has been participating in that curve from hated to merely unloved and then to liked. So while I anticipate that with today's economic weakness, it's not unlikely that in the near term, the oil quote goes lower rather than higher. I believe as a 2-year investment, a 3-year investment, and particularly a 5-year investment, that oil stocks are today where the uranium stocks were some years ago, and where the junior gold miners were in 2022, which is in other words, a different way of saying I'm buying hate.
So how do you position yourself in the gold and sorry, no, not gold, in the oil and gas sector? Because you've got many different ways to play it. You've got the offshore, onshore. You've got the pipeline producers. You've got producers like Exxon and the majors. How do you play it, Rick?
Uh, let me answer the question two different ways. For most of your listeners who don't have 50 years experience in it and aren't willing to devote 20 hours a week to learning it, just buy the best of the best. Just buy Exxon. Exxon's the single finest oil company in the world. Rather than deferring sustaining capital investments, it's increasing sustaining capital investments while increasing new project investments. You get a 4% yield on the finest oil company in the world, selling at a 35 or 40% discount to what I think it's worth, when I think what it's worth will double or triple. That's pretty good. Uh, so for most people, the recommendation would be buy Exxon. If you want to take a little more risk and do a little more work, include a couple of the big US gas producers. I like Devon and Equitable. If you're willing to take some political risk, go up and buy the best of the Canadian producers. They're selling at a discount to their US counterparts, and their US counterparts are selling at a discount to what they're worth. So really, in answer to the question, it depends on how much work you want to put in and how much risk you want to take. I am now just starting personally to look at the juniors, look at the 50 million, 100 million market cap companies that I think in 5 years could give me 10 baggers or 15 baggers, albeit with substantially more risk. The investments that I'm making in the oil juniors today are equivalent to the investments that I made in the gold juniors in 2020. And I fully anticipate that it'll take 4 or 5 years and some failures in order to get paid that way. I got pitched today by a guy who I've known most of my adult life, who I've made an awful lot of money with, who retired and who believed that the opportunities in oil and gas were so compelling that he had to redeem himself from golfing and fishing and come back into the industry. This is a serially successful guy who is backed by one of the finest families in the oil business, who is surrounding himself with a team that built a lot of wealth before. And unusually, this very high quality A player is doing a deal with a 5-year full warrant at a discount to market. Now, if you look at the gold business today, in public companies, you get an amalgam that includes a butcher, a baker, and a candlestick maker, but nobody who's been successful in gold, with a nothing nowhere deposit, doing oversubscribed private placements with no warrant. So I get a superstar with a full 5-year warrant, as opposed to the Three Stooges with an at-market placement. Guess where I'd rather be?
Not the Three Stooges.
Correct.
Well, Rick, it's always a pleasure hearing your insights. Very valuable insights, as always. Where can people find you if they want to see more of your work?
Thank you for asking that. A couple places. The best way to start, if you like what I have to say about natural resources, is go to my website, ruleinvestmentmedia.com, and list your natural resource stocks. I will, for free, with no obligation, rank them, one being best, 10 being worst. I'll comment on your individual issues if I think my comments might have value to you. Side note, no crypto, no tech stocks, no pot stocks. Leave me away from that kind of stuff. The other place to find me is the Rule Classroom, 250 hours of instructional programming, including an 11-part series, Introduction to Natural Resource Investing, all free, ruleinvestmentmedia.com. If you want deeper knowledge, come to one of my boot camps. Every 90 days, we do an 8-hour-long presentation, recordings available for a year, that's a deep dive into one aspect or another of natural resource investing. We've done, Danny, as you know, silver, uranium, a bunch of different stuff. These are very, very, very hard courses. 8 hours, but you'll need to replay the tapes. $99 tuition, cheerfully refunded if you think for any reason that we haven't earned the money that we've charged you with regards to tuition. So, Rule Investment Media, free. Rule Classroom, free. Rule Boot Camps, $99. Those are how you can find me. One other thing, Danny, for your listeners, any of them who are unhappy with their current banks, I suspect that's all of them, to check out my new bank, Battle Bank. If, as an example, you're interested in interest, if you want to get paid interest on your checking account, as an example, which your current bank probably doesn't do, check out Battle Bank. If you want to save outside the US dollar in 20 other currencies worldwide, and your bank won't do that for you, we will. Check out Battle Bank. If you have large stores of gold, silver, platinum, and palladium, or you'd like to buy it, or you'd like to sell it, or you'd like to store it, but particularly if you'd like to access credit in it, Battle Bank believes that bullion is good collateral. Check out battlebank.com. You can access the capital that you have stored in gold and silver without having to sell that gold and silver and pay capital gains tax. That's battlebank.com.
Fantastic stuff here, Rick. Just clarification on the boot camps side of things. People can still buy previous boot camp recordings. It doesn't have to be any, they don't have to be there live in order to experience the boot camp. Okay.
And most of that information is timeless. As you know, Danny, we just did a 3-part gold boot camp series. The first boot camp was physical gold, why own it, how to store it, how to safeguard yourself. The second was the best of the best, the high quality senior producers. The third part was the so-called junior bucket. You can buy that 3-part series at a 50% discount. In other words, you can pay $150 and get all 3 tapes. And a lot of that information was timeless. So by all means, all of the legacy recordings of our boot camps are available for sale.
Excellent.
Well, some of the information was time sensitive. Most of the information, as an example, around uranium, is timeless.
Yep. We'll have the link to your boot camp content down below. So, guys, if you're interested in getting in on the action and catching up on some of Rick's past boot camps, I highly recommend you do, by the way. We'll have a link to that in the description box as well as the pinned comment down below. So be sure to check it out. Rick, always a pleasure, my friend. Thanks so much for coming on. And guys, thank you so much for watching. Be sure to hit that like and subscribe button and comment, "Go, Rick, go," in the comment section. If you agreed or disagreed either way, drop me your thoughts, drop me your comments. I do, in fact, read all the comments, and I will be replying to a small handful of comments as well. I'm always interested in hearing your thoughts, whether they're criticisms or otherwise. So drop them down below. I do read them. And then check us out on Substack at capitalcosm.substack.com to get all of my stuff early and ad-free. And I will catch you later. Bye, guys.